Well, good afternoon, everybody. Ken, do you want to take us away?
Well, folks, welcome to the COVID cancellation conference entitled Successful Investing 3. This class is Managing Your Portfolio, and my name is Ken Kabula. I'm joined by my friend Mark Robertson, and we're going to talk about different ways to manage a portfolio once you've done all the work of finding great stocks to include in the portfolio itself. We do have a little bit of disclaimer to get out of the way first. We're going to be talking about real stocks in real time, and any mention of a stock only means that we're using it for educational purposes only. We are never making a recommendation to buy, to sell, or to hold. We urge you to make those decisions yourself after using some of the tools and tips and tricks that we've put at your disposal. We're going to try to let you know when we own any of the particular stocks that we talk about. We are recording this for future use, and we'll have it up on the Manifest Investing YouTube channel just as soon as we get a chance. And all the views that are expressed today are Mark's ideas and my ideas. We're not representing any group or any philosophy other than our own ideas that we're going to try to let you know about today. If you'd like to receive reminders of the activities that the Mid-Michigan Council does, you can drop an email to nkavula1@comcast.net. She'll make sure that you're on a reminder list, and once you get on that reminder list, you'll be hearing from us only about once a month, and we'll be letting you know about our free activities. We currently remind over 1,000 people throughout the country about what we're doing, in addition to our own members. If you want a copy of these slides from this presentation, drop a note to Mark R. at manifestinvesting.com. And with that, let's get underway, Mark.
All right. All right, so here we are in the third of 5 sessions. This one is portfolio management. Yes, you are going to hear some things that are reinforced and repeated from past sessions, but hopefully strengthened, and just a reminder in what is effective portfolio management, how to be successful doing it. So that's what we are going to be going into, and let's go ahead and click into it. When you're talking about portfolio management, and this is by far one of the most popular and sought topics under a different name, and that different name is when to sell. And so what you're going to see here over the next few minutes is a discussion of selling strategy and caretaking and vigilance for a portfolio. But these are the basic selling strategies that we deploy at Manifest Investing across a number of model portfolios. And in fact, we're aware of a number of real investment clubs which follow these fairly closely. And Ken is going to be spending, I would say, 80% of the time here today talking about this first rule of basically making a portfolio better. That is the objective of any investment club or individual brokerage account. You basically want to make it better, whether it's the return forecast or the quality. There are different rules for core versus non-core, and we'll talk not so much today, but perhaps under a separate topic about this notion of quality degradation. We do deploy a couple of other rules with the model portfolios at Manifest Investing. One of them is that rule of 5 timeout, that if the stock really is misbehaving and lags the market by more than 20% since we actually made the decision, we'll call a timeout and walk away from it. And that is just simply to prevent and preserve, prevent the big downside and preserve capital. And the third one is a kind of a technical indicator. It's not automatic, but anytime that we see a company getting a huge dose of momentum, sometimes it can make sense to think about selling, either partially or fully, when the relative strength index is greater than 80. That just simply means that it's taken off and is doing pretty well. So again, Ken is going to be spending the next several minutes focusing in on that first component, and then we'll circle back and talk about some of the other stuff. I did want to just take a moment. We are going to come back and take a look at the Tin Cup portfolio to close out this discussion. We did recently top $4 million in this model demonstration portfolio. And kind of the overarching, there's a couple things here. Theme is this one is always 100% invested in stocks all the time. There's no effort made to time anything in terms of going to cash allocations or anything like that. So those moments back in the throes of the recession a little over 10 years ago, I mean, that was an ugly moment, one of the worst in stock market history, but you can barely see it now. And I suspect that 10 years from now, this will be less noticeable too. And this has been a pretty successful portfolio. You can see where we reached the milestones, and every million seems to be coming faster and faster. Ken, that's kind of fun.
Mark, why don't you just briefly let people know how Tin Cup is put together?
Well, basically what it came down to is when I had joined the Better Investing as a volunteer back in the mid-1990s, and then I was inspired by Dan Hess to actually formalize it, is basically taking a portfolio and modeling and pretending, it was pretending back then, it's more reality now, that you can take the maximum amount for 401k and put it into stocks. And the stocks were chosen quite simply. We looked for the best companies at the best prices. So better companies at better prices, and just rinse and repeat during this entire cycle, deploying those rules that were on the preceding page. So it really is a demonstration of a retirement account, which is now approximately 25 years old, that has over $4 million. Well, actually, it's dipped down to 3.8 million now, Ken, thanks to the last few days. But that's what it comes down to. We publish those decisions every month at Manifest Investing, and it's just kind of fun to follow along. And we're going to use that as part of the closing comments here today, the actual portfolio. All right.
Terrific.
So with that, that's pretty good performance. And Ken is going to start off by, you want to understand how you're doing to know whether or not your efforts are successful. So take us away, Ken.
Well, I visit a lot of clubs on a pretty regular basis. I've been doing it virtually now for the last year and a half or so. And one of the first questions I always ask is, how are you doing? How's the portfolio growing? And I get greeted a lot of times by silence because clubs don't really know how to answer that question because many of them have never taken a moment to benchmark their growth, to figure out how well they're doing against some standard, or to really sit down and talk with each other about whether all the work they're doing is really contributing to a better return than if they just put all their money into an index fund. If you're using a club accounting piece of software, and software pieces like this are also available for individuals. My wife and I have been using software from Quant9, that's QUANT, and then 9 is a Roman numeral IX. We've been using that software for about, I'm going to guess 22 or 23 years now, and it helps us benchmark all of our investments. We can break them down individually, or we can look at them as a whole, but it's extremely straightforward software to use and gives us wonderful, wonderful reports. But if you're using accounting software in a club setting, those reports are already all built in. All you have to do is get your treasurer to press the right buttons, or in the case of the online software, which almost everybody is using right now, whether it's from iClub or from Vivio, in the online software, you can write the report yourself. The B.I. Baker Model Investment Club uses Vivio software. And if you look, this capture at the bottom of the screen is for the entire length that the club has been in existence. We were founded in January of 2013, and the report was written on the 10th of May, 2021. This is an internal rate of return report. That's what the IRR stands for. And we're comparing what our portfolio is doing against the Vanguard 500 Index Fund, VFINX, which is a pretty standard benchmark that's used throughout the industry to compare growth to. We know that the Vanguard 500 Index Fund, if we were to place the same exact deposits into the fund and make the same exact withdrawals from the fund that we've done in the club, then we would have made on a yearly basis 16.7%, and the portfolio would have been worth just under $203,000. Well, in reality, the portfolio was worth $247,000 plus, and that is a pretty nice increase over what we would have had if we would have done plain vanilla index investing. That's almost 5 points above the market, and that's the stated goal from its founding of the better investing community, and that's to hit that beat the market by 5 points kind of idea. Now, in the beginning, it was phrased as hit 15%. Well, that 15% is 5 points above the average market. The average market over long periods of history has returned about 10%. So when you beat it by 5, you're going to return about 15. The average market since B.I. Baker was formed has been a little bit more kind to investors, and it's returned almost 17, but then again, the club's returned about 21.5. Next slide, please, Mark. That's from founding, and notice that on the benchmark up on top, and this is true of the iClub software or the Bivio software, you can change one or both of the date fields, and once you change those date fields, then you can start to get 1 year, 3 year, and 5 year return numbers, and you can start to see if your performance is improving, if it's declining, and you can start to compare yourself to the kind of returns that mutual funds routinely put out in their publicity. They like to quote how they've been doing against a benchmark for 1, 3, and 5 year periods. Next slide, Mark. Well, here's the B.I. Baker Club. Their 1 year return has been absolutely astonishing, almost 90% in the last 12 months. Notice the dates up on top, going from 5/10/2020 to 5/10/2021. Meanwhile, the Vanguard Fund has been doing almost 47%. Now that's not big beans, folks. That's a pretty decent return there. But if you can beat that return by almost 43 points, then you really have some bragging rights in your corner. Our 3 year returns, the Vanguard Fund at about 20%, the B.I. Baker Club at about 34%, and our 5 year return, the Vanguard Fund at just under 19, and the Baker Club at just under 28%. These are really good returns, and what's nice is that our returns are getting better the more we learn. We ran these reports when we were a very young club, and I'll tell you, they were kind of dismal. It was tough to come up to that benchmark of the Vanguard 500 as a young club. You make a lot of mistakes, you do a lot of boneheaded things, but you learn, and if you continue to learn, then you can begin to move your numbers in a place where you're beating the market. And this club is a living, breathing demonstration of what you can do. Just a group of about 16 or 17 amateurs that meet once a month and make some decisions about buying and selling stocks. That's all the model club is. Next slide, please. It's more important to keep your members informed about how they're doing as well. And so we show this report. And again, it's a report that you can easily develop with either accounting software. This is what the Bivio report looks like. And notice that except for the 2 brand new members whose numbers are not very accurate because there's not enough time between when they joined and what we're looking at right now, the rest of the club, from the point that they joined, has pretty astonishing annualized internal rates of return. The average member down there in the bottom left has an internal rate of return of 21.4%. And you can look down that list there and see that the average for members goes all the way from the low 20s up to above 70%. For the member at the bottom of the list. And she's been a member now for almost 2 years. So that's not a short-term gain. That's a pretty decent gain in a 2-year period, 71% per year. For us, at least, it's a clear reminder that what we're doing is working and that we should double down on what we're doing and keep our discipline so that we don't mess up these numbers and turn our club from a money maker into something that just is a chore to deal with on a monthly basis. Next slide, please.
Yeah, I think we need to send a blanket of roses to Monica.
She's a happy camper, I'll tell you that, Mark. All right. Here's the portfolio, and on first glance, it looks like we own a lot of stocks, but I want you to look down the value column or the shares column, either one, and you'll note that a lot of these have zeros next to them. That's because we embed the stocks that we would really like to own. We embed that into our dashboard so that we make sure that we don't forget that we've vetted these already. We've gone through these. We really like these companies. And at a time when they become buys and at a time when we have money, then we'd like to add them to our portfolio. It's a pretty interesting group of stocks that we own, and we're very pleased. Our star, as far as the portfolio is concerned, is a stock called Mastech. Mastech is down near the bottom right now because it's been doing so well. And you must understand that as a stock does continually better and better and better, many times its future appreciation will fall. And that's exactly what's happening with Mastech right now. We're very, very happy with the growth in Mastech and what we've gotten back for a relatively clean new investment. Our other star is a theme that we seized on about 5 or 6 years ago, and we stuck with that theme. We decided that banks were terribly, terribly beat up. So we found the highest quality bank that we could possibly find. We studied real hard to come up with Western Alliance Bank, and then we ended up buying just a couple of shares here and a couple of shares there until we amassed 400 shares. Meanwhile, the value has grown to almost $42,000 in that bank, and it still has a par that is outstanding going forward. Not only does Manifest Investing suggest that the par is superior, but so does our SSG. And believe me, folks, we really believe in the stock selection guide. We use it in conjunction with everything we do. Nothing is done just by looking at this dashboard, but boy, does this dashboard help us organize our thoughts when it comes to buying and selling. Next slide, please, Mark. The dashboard comes complete with a report card. The report card tells us what an average stock is expected to do in the next 5 years. And in the next 5 years, that MyPAR number, Manifest Investing Potential Average Return number, is somewhere around 5.5%. That's low. Remember that the long-term average return for a stock is around 10%. Well, Nicholson taught us to aim for 5 points above the market. If the average is 5.6, then 5 points above that is 10.6. That defines the bottom of the sweet spot. Nicholson also informed us not to be greedy. He said it's one of the most difficult things in the world to continually beat the market by more than 10 points. So by not being greedy, we set the top of the sweet spot at about 15.6, 10 points above average. Our par, that's a weighted average of the potential for the stocks we own, a weighted average. The bigger holdings contribute more to the number than the smaller holdings. Our par is 11. It's in the sweet spot. Give us an A. Our quality is above 80. That means it's in the top quintile. This is a percentile, the 86th percentile for quality. Give us another A. Our growth is based on sales growth, and George Nicholson suggested that you want to keep sales growth somewhere around 11.5 to 12.5. So at 12.3, it's right where it should be. Give us an A. Our financial strength, we like to keep at 80 or above. Give us an A, but give us one tick away from the 80 that's our target. And the same general idea for EPS stability. How consistent, how straight, how stable is the earnings? And again, at 77, our target is 80, so we're coming darn close. This is a pretty good report card. We'll look at this report card every single meeting, and if it looks like this, our chatter to each other will be, let's not mess it up during the meeting. And we're not afraid to remind each other what our goals are. And if we're doing something boneheaded, we hope that we're going to have 2 or 3 members that are going to remind the rest of the group that if we do whatever it is we want to do, we're going to mess up some of our values. It's important. It's a great way to manage our portfolio. Next slide, Mark. If you want to come up with a different way of coming up with an average number for the stock that's going forward, then you can come up with a 3 to 5 year appreciation potential for the value line universe. It's printed every week right on the front of the weekly brochure that comes out, and you can also access it on their website. And you just have to remind yourself that this number has to be adjusted so that you can come up with a yearly value. Here's the arithmetic. It involves a 4th root because this is a 3 to 5 year number. So we're pointing to the 4th year as kind of in the middle. And when you do that arithmetic, the value line appreciation is about 5.7%. And then if you adjust for yield, because this number does not include yield, if you adjust for yield, you have an average value of about 6.7%. My par and the value line numbers track amazingly close together. There's a little bit of a difference every single day, every single week, but they're close enough that I think you can use either number to determine what average means at the particular time. Next slide, Mark. Here's our sector diversification. We don't obsess about this. It seems to take care of itself. Good opportunities seem to occur in sectors that we don't own a lot of stocks in. We glance at it occasionally to make sure that one sector is not taking over the portfolio. When I visit clubs, it's common many times to see a single sector like technology occupying 40 or 50 or 60 or 70% of the portfolio, that means the club has a real interest in that area, but maybe isn't doing as good a job in watching their diversification as they should. Next slide, please. We also like to watch size diversification, and this one's important to us, but by keeping our sales growth at around that 12% mark, we find that the size diversification takes care of itself as well. In this case, we're looking at the workhorses, which are supposed to occupy about half the portfolio. They're occupying about 45%. The faster growing ones, the recommendation is 25%. We're kind of aggressive sometimes, so our faster growing ones are about 43%, and we don't have quite as much slower growing stocks in here as is recommended, which means that we have room if we find a blue chip that we really like, a slower growing blue chip stock, we have room to put it in the portfolio. It fits quite nicely with what we have right now. But we're very pleased with this size diversification for the portfolio. Again, when I visit clubs, I'm finding the blue piece of this pie diagram. I'm finding the blue piece many times to occupy 60 or 70 or 80% of the whole circle. And when that happens, folks, you end up with a portfolio that you're trying to grow at a number where the stocks within your portfolio aren't going to come even close to helping you grow that quickly. If you want to grow your portfolio at 15%, but the vast majority of your portfolio is kind of stuck to around 6 or 7%, you're just not going to hit that 15% goal until you start adding smaller stocks to the mix, smaller, more faster growing stocks to the mix. Next slide, please.
Well, Ken, I do have a comment. As a child of the 60s, I just wonder if you're ever tempted to tie-dye a shirt using this image.
I don't think you would ever find a picture of me in tie-dye anywhere, Mark. Okay?
Don't challenge me on that.
I am giving you a challenge. I don't think that you would ever find a picture of me with tie-dye, so we'll have to see, okay?
All right, strap yourself in, buddy.
When we're looking at our dashboard, folks, we always like to start by sorting it by par. That means the stocks with the most potential rise to the top of the list. These are usually our buys, but we always check our stock selection guides before we make a buy. We use Manifest and the SSG in coordination with each other. We find that they complement each other. They help us verify and validate our own judgments, and we think that they make us a stronger investor. If our SSG says buy and the numbers coming out of Manifest tell us the same thing, then that's a good indication that we might want to do something with a buy. That's enough said about that. It's a great way to consider what you might do next. I love the percent of total column because that's telling me a little bit about my smaller holdings. So I'm kind of glancing at this top group of stocks. I'm kind of glancing at NVIDIA and Gentex and thinking to myself, those are kind of small compared to the holdings of the other ones near the top. I'll come back to that in a moment. Next slide, please. Stocks that might be considered for a sale will rest at the bottom of the dashboard. And here I've captured the bottom of the dashboard. Now notice 3 of those stocks have 0 in the value column. So 3 of our pounce list stocks, 3 of the stocks we'd like to own are really kind of overvalued right now. Well, that leaves Humana, Schwab, and Mastech for us to take a look at. Remember what the average was at the time I took this slide? Around 5.5%, 6%. Humana is above average, and we hardly ever will sell a stock when it's trading above MyPar. So it's off the hot seat pretty quickly. The other two stocks, we need to make a consideration. Are they core or are they non-core? And I know for some of you that's going to raise a question about what the heck is he talking about? I'm going to tell you what they are and then maybe talk a little bit about the difference. We consider both of these stocks to be core stocks. They're stocks that we probably would like to hold for 8 or 10 or 15 years, and we want to hold them as long as it makes sense to do so. Because they're core stocks, we won't consider selling them unless their potential moves down towards money market. And money market is down around 1% right now. That's what you would get from a certificate of deposit, a CD, or what you might get in a passbook savings account for those dinosaurs that still have passbook savings accounts. Neither one of these two stocks, Schwab or Mastech, are at money market at the moment, so they won't be on the hot seat either. So nothing to sell at the moment, and a couple of opportunities to maybe buy and a little bit of cash to spend. Notice our cash is on the last line down there, about $5,500 in cash. Next slide. Here's what we consider the difference between core and non-core. And George Nicholson gave us permission to move away from up, straight, and parallel with about 20 to 25% of the portfolio. He called it non-traditional investing. And non-traditional investing includes a whole slew of different types of opportunity. It includes cyclicals and turnarounds. It includes special situations. It includes companies of lower quality and companies that don't have a long history. It also includes companies that you might say are not suitable candidates for the core part of your portfolio. You know, they might not have earnings, or they might have earnings for only a single year. Dividing your portfolio like this is not necessary, but it certainly keeps the juices running in any club. And even this high-performing club owns one or two stocks that it considers non-core. Even this high-performing club does not focus 100% on the up, straight, and parallel. The pandemic has certainly moved a couple of our holdings from core to non-core because the business model was completely obliterated when the government shut the company down. And we're looking for a turnaround. We're still holding the company, but we're looking for a turnaround. A turnaround play is not a core stock, but you don't necessarily have to move it out of your portfolio if that's your thesis for that particular stock, whatever it is. Let's go to the next slide. We've divided our portfolio for the tracking portfolio in our roundtable portfolio, also into core and non-core. And notice the difference in growth rates. The core stocks are growing at an average of about 11%, while the non-core stocks have much more aggressive growth. Now, with that aggressive growth comes a little bit more risk, comes a little bit more wondering about how you're going to do the evaluation and whether the evaluation that you've done is going to stay true over a long period of time. Compare the growth rates to the financial strength, EPS stability, and quality rankings of the core, which is boxed in, and the non-core. Our growth overall for the portfolio, it's great. Our quality overall, great. And our par number overall, just a touch light right now. Notice the bottom of the sweet spot is 10.3 and we're at 10. We could use a little bit of a boost up in par, but I think the next time the round table meets, we're going to be pretty satisfied with what we're looking at in this particular portfolio.
Yeah.
Next slide, Mark.
Go on. Just give you a chance to catch a breath and take a drink. We're often asked to quantify or define core versus non-core. And one of the things that we have noticed, and this is just kind of a formative thought, we're scratching our head here, is you can see the difference between these two portfolio components. But what we found is if you take the financial strength and add it to the EPS stability and add it to the quality, now keep in mind financial strength and EPS stability are part of quality, so you're kind of doubling down here. But just take those three numbers, add them together, and I looked at our entire database of about 2,500 companies. If you're above a total of 225 for those three numbers, it's generally the type of company that, again, it's personal choice, personal opinion, going to be regarded as core. We're going to show you a list later with the actual numbers, but just adding those three numbers together tells you a lot. Again, a lot of the time, as Ken was mentioning, when you're dealing with a non-core or turnaround or one of these companies without much track record or a lot more instability, these numbers are lower. And that's just simply what kind of sets them apart. So we do have them divided into two pieces, as shown here in detail by Ken. Go ahead, Ken.
Well, just a couple more points to make. This is the point about Mastech and about Charles Schwab. And again, I want to drive home the point that for core stocks, we don't sell unless the potential, the par value, moves down to money market returns. And it's been down around 1% or so, give or take a couple tenths, for a number of years now. So core stocks we hold on to and we value very highly. How about non-core? If either of these would have been non-core, then we would have considered selling them the moment they moved below average as far as par was concerned. A much shorter leash on a non-core stock. If the par value moves below my par, we're going to consider selling it right away. Now, you might think that moves us to do a lot of selling, but if we sell more than 2 or 3 stocks during an entire year, that's an awful lot for this club or for any of the clubs that I'm involved with to be doing. That kind of discipline, however, keeps us focused on what we think is important. And what's important is not having a beautiful SSG, folks. What's important is what's the return value in section 5. Focus on par. Par is the reason that you're doing the SSG in the first place. And if that par value is telling you 2% and it's a non-core item, then maybe it doesn't belong anymore in your portfolio. If that par value is 7% and you're aiming somewhere at a 15% return for your portfolio, maybe that stock, at the current price at least, doesn't have enough potential for it to be added to your portfolio. After all, that's what portfolio management amounts to: deciding what to add to the portfolio and deciding what to take out of the portfolio. And that's the point that's being made on this slide here. One more slide, I think, and then I'm going to turn it to Mark. Notice that we own 0 shares of those stocks that are marked 0. And for those of you worrying about them interfering with our report card, 0 shares do not interfere at all with any of the averages, since all of the averages on the report card are weighted. Because they're 0 shares, they carry 0 weight in the portfolio, and that means they never enter into the weighted averages at all. Next slide, Mark. So what do you think the club did when we met last Tuesday? I prepared these slides on Monday, and we met on Tuesday. And I'm not going to ask you to put your answers in the question box, but I'm going to tell you what in fact we did, okay? Here we have the dashboards sorted from top to bottom and from percentage of total, and now we can easily see the largest and the smallest holdings. There's our largest holdings at the top, and here's our smallest holdings near the bottom. Well, you know, we looked at Gentex. We really like Gentex. It's a Michigan company. It's involved in the automobile industry. We think the automobile industry is really hot, and we think once the chip situation begins to unwind itself as a problem, that autos are going to take off and be really hot commodities. That means Gentex is going to profit from that. It has a great par value at 12. The sales growth is a little bit low for Gentex, but we feel that as soon as the chip situation unwinds, that sales growth is going to increase as well to match the increased sales of products. So we added our relatively small amount of $5,000. We added it to Gentex and brought its percentage, excuse me, brought its percentage in the portfolio up to where the other percentages were. And Mark, I'm going to let you take over. I have a terrible frog in my throat right now.
I'm just curious. I'll bet there was some discussion of NVIDIA as a potential purchase also.
There was a lot of discussion about NVIDIA as a potential purchase. And the biggest discussion came from the fact that our SSG did not show nearly the par number as the manifest number did. And the reason was, if you look at the PE column, and I know the columns aren't labeled, but you've circled it right now, the analyst consensus average PE is 60, and that yields a pretty decent par value. But when we did our SSG, our consensus estimate going forward for average PE was closer to around 32 or 33. And that does not give us nearly the par that Manifest was showing. Remember I said earlier that we think the two tools complement each other? And here was an example of, we think, complementary tools helping us to avoid a purchase that we felt was probably a little bit iffy in the way that it was being evaluated by just one of the two tools.
Yeah, and my comment on that would be that, again, this is just theory, but I think that the analysts who cover NVIDIA might be hyperventilating a little bit. And that's what drives that number higher from time to time.
Absolutely. Absolutely.
All right. I think this is one of your last slides, Ken.
Sometimes people want to know how big is too big and how small is too small. Well, we own 11 stocks right now in the portfolio. It's just arithmetic to come up with that means that each one on average is about 9%. Divide 11 into 100, you get about 9. We're concerned when a holding begins to become twice that average. So at around 18% for this example, we would be concerned. Western Alliance is about 17 some odd percent right now. So if it moves to that 18, 20, 22% mark in the portfolio, we'll be doing some trimming. There's no doubt in my mind that we'll be doing some trimming. That's not a signal for us to sell the whole thing, however. It's just a signal for us to put some of that money to work somewhere else. And because it also sits at the top of the par list, we're going to be slow to react rather than quick to react.
Exactly.
When a company is about half the size of an average holding, that would be about 4% in this example, that's a signal for us to add to it or to get rid of it, one of the two. Small holdings waste time in your club meetings, and either beef them up or remove them from the portfolio. Now, of course, there are exceptions to that statement. There are always exceptions to every management decision that you make. And if you have good reasons to hold a particular stock at 2% of the portfolio, then state the reasons, agree to them as a group, and move on.
Okay. All right, Neil, I was going to make this point earlier, Ken. You know, a lot also revolves around the fact that this portfolio is okay. In terms of thinking about something to sell, again, you can kind of chill a little bit because the portfolio doesn't need it. The portfolio is not nudging towards selling something and driving that number higher. I mean, yeah, you can do the individual component stuff, but from a portfolio-centered basis, don't need it. It's a very important concept to get down. All right. So do you want to just skip through these, or let's talk about the goals? We're at 50 minutes, 48 minutes.
Okay, well, the goals are easy. Our par we want to keep in the sweet spot. Keep it 5 to 10 above the market average. And that market average is really low right now. We've seen it go in the last year and a half. We've seen that my par number up in the upper teens. So it does vary, and it varies sometimes more quickly than you would like it to vary. That means the sweet spot moves around a little bit.
Mm-hmm.
Just remember that when the market's doing really well, you still want to do better. And when the market's doing very, very poorly, if you're beating the market by 5 or 6 or 7 points, you're still doing okay, even though if it's not the growth that you're used to having. You have to take this as a relative movement and pat yourself on the back when you're doing well, no matter if the tone of the market is really, really good or just average or really, really bad. Our growth we like to keep between 11.5% and 13%. Our quality we like to keep at 80 or above, as the same thing for our financial strength and EPS stability. These are all weighted averages. And again, when we sit down at a meeting, we look at this first. And then if the numbers are good, our advice to each other is let's leave the meeting an hour and a half from now and not mess up any of our numbers. And the clubs had a lot of discipline and been able to do that. Witness the kinds of numbers that I showed you to begin the presentation.
All right. So you already
I told you, and I told you what we did. Yeah.
Okay. Yeah, probably what I would have predicted. Okay. And
I'm just going to point out that there's a worksheet attached to this dashboard where you can like play in the sandbox, and if you turn it into a worksheet, then you can buy and sell, move things around, and as you move things around, the cash amount changes up or down depending if you're buying or selling. So do all the averages, and that play around ability really helps sometimes make final decisions, because you can see the numbers moving as you're buying and selling. And if the numbers are moving to places you don't want to move them, then that's a bad decision, whatever it was you were doing.
Yeah, it's a really good what if, and I've seen clubs actually use it as a proposal engine. You know, if we sell X and buy Y, here's what happens. And it works out pretty well. All right. So we've gone through the goals and stuff. Should we just move on to my stuff?
Yeah, please do, Mark.
Okay. All right, just to kind of wrap things up here a little bit, and I just wanted to put together a quick demonstration of something we kicked around at a recent bull session. Again, we're talking about the selling strategy of holdings within a portfolio. This is not Ken's club that he was talking about. This happens to be the Tin Cup demonstration portfolio. And you can see there are a number of companies that are in both portfolios. But again, from top to bottom, from our largest holding in Amazon to our smallest holding in A2 Milk Company, you can go through some of the same stuff with the report card. Everything's in pretty good shape. Enough growth, enough return forecast, and enough quality. And we want to ask the question, just for kicks, what would Nicholsons Zoning tell us about this portfolio? And I get a real kick out of this one. The bracelet is for what would George do, and the reference to Tin Cup tells you why it's named Tin Cup. And basically all I've done is taken the Manifest Investing database and displayed the holdings of Tin Cup, but added a couple of things where we actually built an upside downside ratio for the holdings in Tin Cup. The low price is always the 52-week low, and the high price in the zoning that's done here is the 5-year price forecast. So that's what we use to form the upside downside ratio. We'll come back to core in a minute. But what that does allow you to do is put together the buy below price for every company and the sell above price for every company, so you can basically see where they're at. And much like the Baker Model Club that Ken was just talking about, this model portfolio actually has Charles Schwab, which has been doing pretty well here lately. It actually does come up in the sell zone of a consensus-based stock selection guide. The one thing that I would say you might want to watch out for is they are in the middle of a fairly substantial merger, and numbers can be disrupted. Numbers, expectations, forecasts. So you maybe give it a little bit of time to shake out. But by the same token, it's been crunching along pretty good. It has no upside, and it does show up in the sell zone. The reason I did this is Nicholson used to visit investment clubs, and he would put together a portfolio upside downside ratio, basically using the math that you see here in this column. And what he was looking for is, again, we try to buy companies when there's a 3-to-1 or better upside downside ratio. What he was always on the lookout for was company or clubs that were reluctant to sell, and that upside downside ratio had actually sunk below 1. And if it got below 1, then he would basically urge them to begin thinking about, making some of the selling type transactions we've been talking about here this hour. So in this case, this one checks out pretty good. What I find affirming and perhaps validating is that, again, when we go through the dashboards and sort of from top to bottom, highest return forecast to lowest return forecast, it matches up pretty well with the zoning over here. And I don't know about you, but I think that kind of kicks butt a little bit. That's what I suggested to Ken. And here are some of those core numbers from top to bottom. The ones in green are kind of in the middle zone. I think Amazon is becoming a core holding. I think Bristol Myers Squibb might come back to core, but they've been slipping a little bit in a number of areas. But the vast majority of this particular portfolio qualifies as core by adding up those three numbers. So again, it's just something to chew on. So again, just to reiterate, most of the stuff Ken was talking about is take the portfolio, understand where you're at, understand your performance, and don't mess it up. That's rule number 1 on this chart. And then we have been deploying rule number 2 and rule number 3 for the roundtable tracking portfolio for a few years now. And we'll just leave you with one thought. and it's this lot. We've checked in on this number a few times. This is your update. What if we only sold the selections that are made for the roundtable portfolio when we're forced by mergers, acquisitions, or perhaps a company disappearing from the planet? But we're simply buying and holding, buying and forgetting, if you want to think of it that way. And with no sell transactions at all in that roundtable tracking portfolio, we end up with a return of approximately 16%. Deploying these rules here and trying to stick to them, it's always a matter of discipline. Every once in a while, Cy Lynch has to preach a little bit and encourage us to follow our own advice and implement some of those rules. Well, in following those disciplines, those selling disciplines, the return is a little over 19%, and I would argue that's enough to notice. So again, it is just one sample, but you're basically talking about the difference between never selling versus strategically selling and managing a portfolio with good stewardship, adding these type of returns over the years. And again, you put 3 or 4% on top of a return over the long term, it makes a massive difference in long-term performance. Any thoughts or comments on that, Ken?
No, I think you said it well, Mark.
Okay, I'm glad to see that the frog is gone. All right, our next session is tomorrow. In fact, the aforementioned Cy Lynch will actually be back tomorrow with a session on stacking the deck in your favor, basically sharing some tips and tricks on stock studies that he's been doing for a few decades now. So he will be back at 2 o'clock, and then 3 o'clock tomorrow we do have our panel session where we will have 8 distinguished guests and stock selection people making a couple of selections, so you get 16 ideas to take home tomorrow afternoon. Anything else you'd like to add, Ken?
No, I don't think so, Mark, except that these are pretty exciting picks that are being made. And I learned something in listening to some of the names that are being bandied around. So I'm sure that our audience will find some interesting ideas.
Well, it's always kind of interesting to see if there's any mode of swinging for the fences in situations like this, because it's not like we're competitive, right, Ken? We do like to bring ideas that achieve incrementally superior returns, and we do like to beat each other, and that's in the spirit of making each other better. And that is what it's all about. It's what every single roundtable is about, our monthly webcasts. If you're not familiar with the roundtable, I would invite you to go to YouTube, search on Manifest Investing, and sample one of them, because we have a 19% rate of return going over 11 years now on the selections that have been made for that particular tracking portfolio. So there are some worthy ideas that erupt on a fairly regular basis. So there's your reminder. If you have follow-up questions or you'd like copies of the slides, send me an email. And if you are not a member of Manifest Investing and you're just curious about all the stuff that's being kicked around, it is a subscription service that I run, but send me a note and I'd be happy to give you a fully functional free test drive so you can make your own decision about the utility and benefit that you can derive from it. So with that, I think we're ready to leave you with the view of that Omaha sky that we've talked about at a few of our sessions.
Mark, we do have quite a extensive question list here, and I'm willing to deal with a little bit of it for the next 10 minutes after we close the session down. So folks, if you asked a question, if you want to stick around, Mark and I will try to handle as many as we can in the next 10 or 15 minutes here.
Okay, I'm going to go ahead and stop the recording for now and get it ready for archiving and sharing with all of you. So thanks, everybody. Thank you, Ken.
Thank you, Mark. Good afternoon, everybody.
Take care, everybody.